Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. Tur dal prices have hit 200 rupees per kilogram in some places in India. For a nation whose diet is increasingly becoming protein-led and thus higher consumption of pulses like tur dal, this comes as a shock. The government has responded by, among other things, launching a series of raids on hoarders in different parts of the country. Now, this has already released some stock. In addition, the government has imported tur dal too. But the larger question is of demand and supply. India's demand is growing to some extent and supply is not. There is not enough tur dal being grown in India and not too many countries growing it either. How can India prepare for the larger demand-supply imbalances that are bound to increase not just in tur dal but elsewhere too, and on which point of the food chain should the focus be highest?
It's been a week of high-level meetings on galloping prices of pulses. The finance minister met importers and ministry officials. The government claims over 50,000 tons of dals have been seized from hoarders, but there's little let-up in retail prices. The government says 5,000 metric tons of imported pulses have already arrived and are being distributed. Jaitley urged strong action by the states to check the menace.
We have imported 5,000 tons. 3,000 more tons is in the process of landing. Compared to these quantities, the amount which has been recovered in these raids has already touched 36,000 metric tons. So 36,000 metric tons has been recovered, and that now will be slowly offloaded into the market.
In separate meetings, the Cabinet Secretary took stock of production, procurement and availability.
The government is concerned about price rise of pulses. It has taken several measures to control the prices of pulses. It has banned export of pulses. There is zero import duty on import of pulses. So continuously we are making efforts to increase the availability of pulses even through imports.
The issue has taken on strong political hues too. Union Agriculture Minister Radha Mohan Singh kicked up a controversy, claiming Bihar was the biggest culprit behind declining production. He said output fell from 5.43 lakh tons in 2012-13 to 4.2 lakh tons in 2014-15. Politically charged brickbats have resounded.
राज्यों को पत्र दिया गया कि प्याज, आलू और दाल आपके राज्य में लगता है कि स्टॉक कम है, महंगा होने वाला है, तो आप प्रपोजल दीजिए, पूरा वर्किंग कैपिटल देंगे। लेकिन दुर्भाग्य था कि राज्यों ने इस पर ध्यान नहीं दिया। अब आंध्र और तेलंगाना ध्यान दे रहा है।
As per data from the Consumer Affairs Ministry, retail price of tur dal is as high as 210 rupees per kilogram. Urad dal soars at 190 rupees per kg. Bureau Report, Rajya Sabha Television.
Well, joining me now are Madan, Sabnavis, Chief Economist at KA Ratings, and Anil, Bagani, Research Analyst at commoditiescontrol.com. Gentlemen, thank you very much for joining us. Madan, let me start with you. You know, prices of pulses and tur dal in specific have been rising for some time. So, to some extent, there was an idea that this could happen. But yet, we were not able to arrest the problem when it seems to have suddenly flared up. What's the background to this?
So actually, if you look at, for example, the production of tur dal in the last 3 years, it's been fairly erratic. It's been coming down. Now the thing about pulses, especially for tur rather than moong, is that you grow it once a year, and we import the balance which is required. And until the next season comes, you just wait and hope that the next crop will be better. Now, when the first advance estimates of the Ministry of Agriculture said that the output is going to be lower, I think that's what's been the trigger point as such when the prices have started moving up in the market. And because we have a limited amount of stocks left, arrivals come from probably November onwards. Even in case you have to import it, which the government did make certain sounds about it, it's a case of timing of the imports as to when they really come in. So I think
you're saying there was a supply problem building up?
It's a supply problem which is built up, and it's been erratic in the last 3-4 years. So if you look at it for all these three pulses, on an average we grow around 5 million tons in a year. So if it comes on slightly, you'll have to import more. And once we import more, international prices also start moving up, since India is the largest producer and consumer of pulses.
Anil, what were the markets telling us? I mean, you know, prices is one way of knowing that there is a demand-supply problem. Were there any other signals?
No, basically the prices have been determined by demand supply scenario itself. As Mr. Madan has already said that there is a crunch of supply over there. And see, now what is happening is that our production is not meeting to our consumption. We are consuming like what we if we are consuming 100%, then still we are importing 20 to 25% more pulses from other countries, other exporters like Myanmar, South Africa, South African continent and Canada. So what we need to maintain is that we have to increase our yield or our production. For that we need to give some farmers some technology benefits like irrigation facilities and some other
so
things.
in the food chain you're saying work on 2 or 3 levels, including incentivizing farmers who are obviously maybe focused on other crops, and make sure that you're managing your imports better or at the right time at least. Am I right?
Yeah, absolutely. I think I'll agree with him. I think that's what has to be done. But the sad part is, if you look at actually, if you drop a P&L account for various crops in the country and you say that if I have a piece of land and I grow pulses or I grow rice or wheat, and look at my cost of cultivation and the price which I'm going to receive, as well as an assured supply, assured buyer in the form of the Food Corporation of India, it makes a lot of sense for me to actually grow rice and wheat. So while we always keep saying that we need to grow more pulses, incentivize farmers, it's actually not happening. It's not really practical. So therefore, if you see our production levels, they've remained more or less stagnant.
Right. So let me ask you 2 larger questions. One is, there is a changing profile of consumption, right? So people are obviously consuming more protein weighted
No, in fact, Govindraj, I would take a different view, because I think this is something which everybody is saying, that people are eating more pulses as your income increases. You move from, say, cereals to pulses. But actually, if you look at NSS data, it really doesn't show that. In fact, when your income increases, you move more towards non-food items rather than switch across food items. I think this is a kind of an excuse we've given, that people are eating more protein. I think the Reserve Bank has done it even earlier, saying that protein consumption has gone up, which according to me is fairly.
But it happens everywhere, right? Including in
but I don't think it's
China,
happening in a big way. But it hasn't happened in a very big way, at least as far as pulses is concerned. Because if I look at it, look at the data, and you say that am I producing more, am I consuming more? Our imports remain that 15-20% are still being imported. My production levels, I mean, almost.
And consumption is 3.3 to 4 million tons.
Exactly. So therefore, we're left with the same kind of numbers. So I don't think we're consuming more, because if we have to consume more, we can be importing more. But our imports have not really been going up.
So then you're saying it's purely a supply mismatch?
It's purely a mismatch and lack of interest in growing pulses. I think that's the basic problem which we have.
Because of the nature of the crop.
It's the nature of the crop.
Okay. So let's look at the larger question then. There are some lessons from pulses. Now, whether it's on the demand side or the supply side, what can we apply to our approach to agriculture as a whole?
See, we need to have a diversified set of product mix in the agriculture basket. See, it's not a case of saying that we should just be growing pulses, because tomorrow we could have a problem in sugar. Sometime back, I remember we had a problem in sugar. So it could happen for any of these crops except rice.
And you're seeing this trend that our ability to respond to situations is similar across
It's almost the
crops?
same. We always first shout, blame the government, then you say that get hold of, in fact, another thing which you say is that get hold of the hoarders.
So we've raided the hoarders,
No, but actually I think even the hoarding story, I think, has to be told in the right fashion, because if you look at all agricultural crops, you're growing it once, you're keeping it for 12 months. So somebody has to be holding it. Now, whether you're calling it stocking it or whether you're hoarding it, I think the distinction is very, very oblique out there. So it's good news for the newspapers to say that we have gotten down on the hoarders, we've gotten X million tons, X thousand tons which have come out. But to my mind, that may just be a bit of harassment. Maybe at the margin, people are obviously.
Because on the flip side, you also need a buffer stock.
That's the important part. I think buffer stock is something which we have to build. We probably have to diversify just from rice and wheat and go over to other crops which are vulnerable.
Okay. Anil, how are you seeing price trends? Now, we've seen 200 rupees a kilo in parts of India now. What's your market sense telling you?
See, as long as this policy, government is latest policy on hoarders, and they have seized some 36,000 tons of pulses from the hoarders. This will impact for a shorter period of time, and the prices may cool down within 1 or 2 months. But as long as the impact on the farmers, it is not going to be benefited to the farmers, because at the time when their crops will hit to the markets, or arrivals will started to flow in the markets, whatever the limited supply, I am not talking about they are growing exponentially and the supply will come on a large scale, but whatever the supply will come, the farmers are not going to get these types of rates for their goods. They will get the lesser amount, like whenever the prices will be cooled down. So these actions are late by this time. This should have been taken in advance.
And particularly since the signals were already there.
2 months before.
And the signals were there. Prices were rising.
Signals were there. Because see, the corporate funds who are the holders of this commodity are actually been benefited by this time when the prices were rising. So now even if you are seizing some amount of pulses, they have already done their trick.
Okay. So this seizing, does it mean that they don't get paid anything, or?
No, they don't get paid anything.
Okay.
So it's basically saying that you're holding, you're doing something which is against the law, because we have Essential Commodities Act which says how much a wholesaler or a retailer can hold on to. So I think these guys could just probably be getting victimized to a certain extent. As I told you, am I really because the stocks have to remain somewhere.
Right.
The farmer sells immediately at the time of harvest. So somebody, you or I, who is a wholesaler or the retailer, have to make it available throughout the year.
Right. So okay, so let's look ahead now. So what are the key lessons from this whole problem or crisis that we've seen, and how do we play those lessons out into all the key crops that we consume or will likely to consume, particularly if consumption trends change?
See, essentially, I think we need to keep buffers for all the vulnerable crops. And I think when prices keep moving up, we cannot really avoid it. Because I think in agriculture, we have a situation where we are growing as much as is required for consumption. And whatever balance is required, we are going through for imports. So I think this kind of an equation cannot change. We can, of course, say that we need to grow more of it, but that's more at this particular table. It's not happened in the last 10 years, so I don't see why it should be happening anytime soon. But the important part is that the moment I recognize such a problem exists, I think we are always in a state of denial. Even when we had the onion problem or the tomato problem, we first say that, look, it's the hoarder, let's get hold of them. We don't actually approach the problem by saying, okay, I have an onion problem, I have a pulses problem, let me start importing immediately. Make sure that the processes of importing are fast. Because normally by the time you decide to import, you have your tenders, they land up at the ports. Very often you hear that the stocks have come to the ports,
and they're lying
but
there,
they're still lying there, then you say it's a state government issue.
But import is a temporary solution, right? What is the longer term?
Longer term, it's only in case of increasing production, and to my mind, in case it hasn't happened.
But in the case of tur dal, you may not be able to do it in India. You have to do it outside.
You have to do it outside. We are talking of doing contract farming, so it's actually analogous to saying importing. I'm going to use somebody else's land to grow the same things. Now, is it really worthwhile? Is it going to be profitable? And if you're going to, I think we do some kind of contract farming in countries in Africa. Again, there are security issues there, so it hasn't really taken off in a big way. So I think this is a kind of problem in agriculture which we're going to continue to have, and I think the only solution is to have certain kind of buffer stocking being done. Or I would say something which is more bizarre is that the state government should take interest in farming. So state government getting into farming, picking up the vulnerable crops, make it a kind of a public sector enterprise. You provide employment, you provide the seeds, you also make sure that output comes in, and you're able to cool the markets as
but that seems to be contrary to everything else, isn't it?
That's what everybody says, that the government shouldn't be getting out of productive activity. But today what happens is that finally the onus falls on the government. All of us say, what is the government doing? As if it's the government's duty to make sure I get tomatoes or onions or pulses at a low price. I mean, if we are making the government responsible and the government is taking responsibility.
So you're saying it should play a role in production as well?
It should play a role in production. I think it may not be a bad idea. It may sound a bit bizarre, as I told you, in today's world, but it could probably help.
Right. So Anil, you talked about yield as a focus area, right?
Yield,
what are the
yield
other
should be a focus. See,
productivity
yield,
yield.
Why yield is not going up? There are some reasons about it. First, we don't have that technology what others possesses. So we first action government needs to do is that to provide ample technology, a good technology to the farmers, a good quality of seeds, then irrigation facilities, and apart from it, what they are sowing, what the farmer is sowing, he should get a profitable amount of return from it. Now, what is happening in pulses, especially for pulses, is that whenever farmer is approaching in the market with his goods, he is not getting the actual return for it. And the cost of production is very high for those say for tur and chana. The cost of production is very high, and since we are dependent upon monsoon also, so these all factors accumulated into the worst scenario for farmers.
Got it. So Madan, if you were to look forward now, these are things we know, right, about either focusing on yield, on technology, on irrigation, on better facilities for cold supply and distribution. But what do we need to do now? Or what can we focus more on from an execution?
See, execution part is make sure that the supplies are made available, try and cool down the prices. So all these things which we're doing at a margin of trying to the extent that hoarding, black marketing has actually pushed up the prices, we'll be able to cool it. But what our own history has shown is that the moment we have a problem, we have a solution, we forget about this year, we go to the next year, we actually forget about it. Because I remember I was in the commodity market when we had the same pulses crisis, I think 2006 or 2007. where the price of tur dal actually had gone up. It was the same normal suspect.
2009 itself, 100 rupees per kilogram.
Now, when the price went up, everybody made a noise. We said the same things in all these discussions. By the time we went to 2010, things became normal. We forgot about it. Then it became an onion problem or a tomato problem or a sugar problem. So I think the thing is that these kind of volatility in the market is bound to be there, and only thing which you can do is that you'll have to bear up and just hope that when the prices return to an equilibrium, it will go back to the old price. Now, what we have seen is that if I've gone to 200 rupees, I may not go back to the price of say 80 or 90, which was prevailing before the crisis took off.
And maybe look at, as you said, some slightly different solutions where maybe a government could play a role.
Right.
It's a solution. Not many may agree with it, but it's a solution nevertheless. On that, we've run out of time. Thank you both for joining us. We need to take a break. On the other side, we look at India's ratings and what lies ahead. Stay with us. Welcome back. Here with Policy Watch. Rating agency Standard & Poor's has kept India's sovereign rating at the lowest investment grade of BBB- with a stable outlook, saying factors such as its sound external position are offset by low income and weak public finances. Other rating agencies like Moody's and Fitch Ratings have rated India at the lowest investment grade too. Now the question is, should we be concerned about what the rating agencies are saying and their observations, and if so, how? Or are the rating agencies not being fair? To discuss this, I am joined by Saugata, Bhattacharya, Chief Economist, Axis Bank, Anindya, Banerjee, Analyst at Kotak Securities, and Rakesh, Valecha, Head, Credit and Market Research at India Ratings and Research.
No change in Standard & Poor's sovereign rating on India. The lowest investment grade and a stable outlook remains. The government was hoping for an upgrade in the backdrop of increased investment and economic activity, but S&P said an upgrade was possible only next year, even warning that a downward pressure on ratings could emerge if growth disappoints with stalling of reforms. The agency projected that the Indian economy would grow at 7.4% this year, forecasting an average growth rate of 8% for the next 5 years. Despite the volatility in trade, it said current account deficit would stay at 1.4% for 3 years. India's low per capita has been defined as the constraint for a rating upgrade. The Indian government downplayed the report, saying it expects 7.5% plus growth this year, insisting that the economy's inherent stability factors remain strong. Thus said the government would continue on the reforms path to improve the economy and strengthen inherent stability. Bureau Report, Rajya Sabha Television.
Gentlemen, thank you very much for joining me. Saugata, let me start with you. Sound external position offset by low income and weak public finances is what Standard & Poor's says when it gives the reason for maintaining this BBB- status. How do you interpret? There's some good news and there's not some good news.
Well, I'd interpret this in the light of the ratings, sovereign ratings of some of our emerging market peers. I believe looking at it from that perspective, India definitely deserved a ratings outlook upgrade, if not an actual ratings upgrade, because I mean, remember this, they have been at this
so you're saying instead of stable, it should have been positive.
It upgraded, and then we wait and watch for the fiscal side to improve. If you look at the macro fundamentals of some of our larger emerging markets, Turkey, Brazil, Indonesia, India's fundamentals definitely are much better. I mean, what we lack is the level of income. The others are relatively other than Indonesia.
How do rating agencies work? Do they look at absolutes or comparatives?
The absolutes are important because I mean a country's ability to move to a higher level of growth will depend on the absolutes. But I mean, if you have to have some standard benchmark, this can't be completely arbitrary. So they have to have some certain benchmarks, and looking at the benchmarks, the relative rankings would definitely play a role.
Right. Okay. So Rakesh, your firm too, that's Fitch Ratings, has maintained a sort of lowest investment grade. Walk us through broadly the reasons why India stands where it is today.
Yeah, hi Govind. No, I think I would just like to clarify first. Obviously, we are India Ratings, and so while Fitch has an outstanding rating, that need not necessarily be the same view that we may probably have. So we continue to track India more from a macro fundamental point of view. So coming back to your query, I think as far as India's sovereign rating as from Fitch is concerned, that is at a BBB-, which is the lowest investment grade rating. I think the key fundamental drivers of that are clearly the public finances, which probably continue to constrain the rating at this moment, and some of the structural weaknesses that we have been talking about in terms of providing the fillip and the support to the growth, which hopefully then would provide a more sustainable path going forward. So I think public finances and structural weaknesses probably are some of the weaknesses at this moment, whereas probably on the external side we are a bit more well placed compared to maybe some of the other emerging markets.
So Anindya, what's the good news that, whether or not rating agencies look at it?
I would say the good news over here is that on relative scale, India is placed much better than the other EMs, as Saugata said. So that makes us a compelling investment case. Yes, say an upgrade in the outlook would have helped, but as of now, the investors are not complaining. So they are finding India attractive on a relative term, and that is bringing in the capital.
Okay.
Yes.
So you're saying therefore we should not be too concerned about this rating because people are coming in any case?
I would say yes in the short term, but in the long run, if we can stick with the improvement in the public finances, which in fact all the three rating agencies have highlighted, I think it can be a case where we can eventually get to a place where the upgrade happens.
So Saugata, this also talks about, apart from fiscal deficit, low per capita income as a deterrent. Now, could one look at it the other way around? When you have investment, then you perhaps spur more growth and higher per capita incomes.
No, I think this is completely on the ball because this is exactly, look at the fiscal side, not just in comparison to our emerging market peers, but also relative to where we ourselves were over the past. There are some committed expenditures which you cannot do anything very much about. So interest, subsidies actually the government has done a lot. This government, starting with the work of the previous government, the subsidy levels have been brought down, and even if now oil prices, say for instance, begin to climb up, some of the diesel deregulation and other measures that have taken will ensure that some of these subsidies, and particularly the work with the DBT, the cash transfers, that's going forward. So I think structurally the nature of the fiscal deficit has become qualitatively so much better. The second thing, the more important thing that you are mentioning, that in this environment we need to get growth up, and growth probably in this current environment has to come in from the government side, rather than because the corporate balance sheets cannot support the kind of growth that we need to get per capita income growth out. And given this kind of growth, and the government, you're seeing that the capital expenditures, the rates of increase of capital expenditures, particularly roads, some of the other sectors, has indeed increased. Given the constraint, given the tax collections and things that, and the need to pay out some of the revenue expenditures, capital expenditures has increased. So qualitatively, both from your point that to get growth up, public investment is needed to crowd in private investment at this point in time, and some of the other measures in terms of the procedural measures in DBT, cash transfers, I think the government has done a very good job, and I think that's what that's the delta that needed to happen.
And you're saying the path should be good enough to give India a better rating.
Right.
Anindya, you agree?
Yes, I do. I do. In fact, I would add to that. So, in order to support growth, if the government steps in more, which I think they have to, because the corporate capex is going to disappoint for quite some time. So then we can see a short-term deterioration in the public finances. Say, for example, if you look at how the indirect taxes have gone up, like the excise on petroleum goods have gone up, and also the service tax has gone up. You generally don't see a situation where the economy is weak and the government is raising taxes. But this government had to do it because they had to distribute the resources.
Right. So, Rakesh, let me come back to you. So, if you were to look forward now, there could be a combination of measures which a country like India should be looking at in order to improve its rating. So, some would be short term, some would be relatively longer term. Where would you place your bets on?
No, I think probably one of the things that the government has been trying to address is clearly the ease of doing business. And I think, as everybody's been highlighting, investment is something which has not necessarily been flowing. Obviously, there are fundamental reasons why corporates today are not investing, and which will take its own sweet time. But clearly, in terms of creating an investment climate for investors to come in and start investing in India, I think the ease of doing business is something which is definitely a critical parameter, whether I look at it in terms of capital allocation or whether I look at it in terms of land and labor changes which need to be made. I think some of these structural issues, as they get addressed, I think will probably put India in a much better footing as far as growth is concerned, and maybe a growth which is probably much more sustainable without getting into the inflation part of the trajectory. So I think I would probably say some of these ease of doing business parameters, which again the government remains committed, would definitely be the key drivers as to how you think the overall macroeconomy will develop over the next few years.
So, Saugata, should we be, again, I asked this question earlier as well, so should we be concerned about what the rating agencies are doing, in as much as does it call for some shifts in strategy, tactics, focus on internal versus external and so on, or should we be really focusing on what we are doing already and being confident about it?
So, two parts to your question. One, I think we should be concerned, yes, because there's plenty of capital flows at stake. So, the overall cost of borrowing will come down once we get a ratings upgrade. So, that's something that cheaper funds will definitely lead to a push in capex. So
and is that one of the biggest reasons why we should be concerned?
That's right. I mean, because the ability to get
Hmm.
cheap capital, tap global capital pools at cheaper rates, I think is one reason why we should be looking for a, and we need to be advocating such an upgrade more actively, more proactively, I guess. But internally, as you said, I mean, we are progressing down a trajectory of reform. So, I mean, we need to be pursuing down the trajectory, not get too worried, overly worried about what an external ratings agency does. So long as global multilaterals and others recognize global investor pools, and we are already beginning to see the kind of PE investments, the risk capital that we are seeing beginning to flow into the country is already an acknowledgement that the macro fundamentals, including the fiscal side, is more or less stable and is likely to improve going forward. But yes, exactly as you said, we should be single-mindedly focusing on different facets of reform and at the same time advocating. Talking to the ratings agencies, other agencies, in order to get an upgrade.
Right. So, Anindya, you were comparing with other emerging markets. How does that scenario look in the next 6 months in a purely comparative way?
See, a large part of the emerging market sphere are primarily countries who have a large dependence on the resource sector. So India is a unique position. India has, yes, we have a chunk of the economy who is dependent on the resource prices, but there's also a significant chunk of the economy who are resource users on a net basis. So we have gained from this commodity deflation, which has hit the world. So that has made India an attractive destination, as Dr. Rajan used the phrase, an island of calm in the ocean of chaos. So it's kind of that. So which is what
and that's an advantage you feel we are going to hold for some time. That wasn't really my question.
Yes, I think that will hold out for some time.
Rakesh, last question rather. What's your sense going forward? When do you think we could hope for assuming things are going as forecast or predicted? When do you think things could look up on the rating front?
Yeah, I think as I said, it's more that clearly the government has to crowd in private investments, and so how quickly government does that, I think, will really determine at what pace the country continues to grow. So I think we had done a fairly detailed analysis to say that probably corporate capex will take another 2-3 years from here on to pick up. So in the interim, it's still definitely the government spending. If it's a focused government spending, which I think they've shown signs of, on capital expenditure, which is productive in nature, I think we probably are on the right trajectory and should be able to sustain growth from here on.
I think one very major component of a ratings thing are the quality of the institutions, the laws, the legal reforms, the legal institutions, the judiciary, the executive, and so on. I think we are progressing around the path. The bankruptcy laws, say for instance, as and when they come in, the entire the Indian Financial Code that's come in, the ease of doing business, as we heard. I mean, so all of these processes are beginning to move in place. The institutions which actually govern the economic reforms, and I think that's one very powerful argument. Remember too that coming back to the fiscal deficit, India has very little negligible external debt. So we are
and that's been acknowledged.
External sovereign debt. So that's one very powerful thing which hides the quality of the fiscal deficit to a certain extent.
Right. So things are looking good, but obviously we don't expect something on the ratings front immediately. But at some point, as all these factors come together, things should improve.
That's absolutely on the dot.
Right. We've run out of time. Thank you so much. We've run out of time on Policy Watch. We'll be back next week, same time. Thanks for watching.